Welcome friends, welcome to Bankers Plus Academy. In today's video, we are going to discuss DPG or Deferred Payment Guarantee. So in this video, we will see what is DPG, what is its purpose and how it is working. To start with, Deferred Payment Guarantee is a guarantee issued for deferred payment. Deferred payment means payment made on a deferred date. In other words, deferred payment is payment made in installments at regular intervals. So, Deferred Payment Guarantee or DPG guarantees prompt payment of the installments in a transaction. Deferred payment guarantees are usually used in the case of purchase of capital goods, machinery, etc., where the seller offers credit to the buyer and the buyer's bank guarantees due payments to the seller. That is, in addition to the buyer, the payment is guaranteed by the buyer's bank also. When the seller obtains a DPG, his payment is assured because the guarantee has been issued by a bank. So he will get his payment even if the buyer does not have funds on the due date. Now, let's see how the DPG mechanism works. Suppose a company X in USA is selling a machinery to a party in India called Y for an amount of $1 million. So, $1 million is the cost of the machinery to be paid to the seller. But Y, the buyer, is not able to make the full payment immediately. X, the buyer, is ready to help him and ship the machinery to Y if he makes a down payment of 10% of the value of the goods immediately. X is also ready to accept the balance amount in quarterly installments running over a period of 5 years. But for these deferred payments or future installments, he requires a guarantee from the buyer's bank. The buyer is agreeable to this offer. So they enter into an agreement with payment terms as mentioned above, where the seller is ready to accept a down payment followed by deferred payment guarantee from the buyer. In this case, Mr. Y is to immediately make a down payment of $100,000 to X, being 10% of the cost of the machinery. Afterwards, he is to make quarterly payments for the next 5 years for the balance amount of $900,000. Suppose Mr. X is not charging any interest for the deferred payments, so that Mr. Y has to pay only $900,000 over a period of 5 years. 5 years means 20 quarters. So it comes to $45,000 every quarter. In other words, the deferred payment guarantee is to be issued for the payment of the above 20 installments. For this, X will be drawing usance bills of exchange for all the above 20 installments. These bills of exchange will be accepted by Mr. Y. Now, the same bills of exchange will be co-accepted by X bank also, who have sanctioned the deferred payment guarantee limit to X. So the bills of exchange drawn by X on Y for the future installments are accepted by X and co-accepted by his bank. Now, X is fully safe and comfortable as he is assured of the payment of installments on due dates because the payments have been guaranteed by a bank. Mr. X can now get the bills of exchange discounted with his bank so that he gets his payment from his bank. He need not wait for the due dates of each of the installments. He will get money from his bank immediately on discounting the bills of exchange. On due date, his bank will present the bills of exchange to Y's bank. And when the bills are received by the Wise bank, they will deduct the installment amount from Wise account and pay to the buyer's bank. Even if there is no sufficient balance in Wise account, his bank has to make payment to X bank because they have co-accepted the bill of exchange. Afterwards, they can recover the same amount from X. This is how DPG works. So the DPG is a contingent liability for the bank. As long as the buyer is making available funds in his account for honoring the bills of exchange, there is no outlay of funds from the bank's side. But if the buyer fails to provide funds in his account, the bank will have to make payments to the seller's bank. Deferred payment guarantee and term loan are given almost for the same purpose. Therefore, the appraisal for both of the above facilities is similar. In the case of term loans, bank gets interest, and in the case of DPG, bank gets commission. Reserve Bank of India has instructed banks to ensure proposals for deferred payment guarantees are examined with regard to profitability and cash flows of the project, and to ensure that sufficient surpluses are generated by the borrowing units to meet their commitments at regular intervals. And also, it should be ensured that the total credit facilities, including the proposed DPG, should not exceed the prescribed exposure ceilings. So that's about DPG. Hope that you have found this video useful. Thank you.